What's the difference between a 30-year and a 15-year fixed-rate mortgage? Did you know that the interest rate on a 15-year fixed-rate mortgage is a little lower than a 30-year mortgage term? I'd like to explain the differences between the two, but in addition, give you some alternative fixed-rate terms for you to think about when making the decision on how quickly you want to build equity in your home. So let's start with a 30-year term mortgage. It's the option that gives you the lowest monthly payment, but over the years you're paying back the largest amount of interest if you make your regular monthly payments and take 30 years to do so. In regards to the 15-year term mortgage, you're making a higher monthly payment, but in return you pay back the least amount of interest. So let's compare. Regardless of what loan amount you end up with, the principal and interest payment on a 15-year mortgage is approximately 35% higher than on a 30-year term. For example, if your principal and interest payment is $1,000 per month on a 30-year mortgage, the payment on a 15-year term would be $1,350 per month. However, comparing the savings between the two loans, you would pay 55% less in interest versus a 30-year term. So let's say that the interest rate on a 30-year term is $100,000. The interest paid on a 15-year loan would be $45,000, or a savings of $55,000. But wait, there's a couple of other alternatives that can also save you money. You may want to look at the 20 and the 25-year fixed rate option. So here are a couple of comparisons. The payment on a 25-year fixed rate mortgage is only about 10% higher than on a 30-year loan. However, the interest savings averages 20%. For example, if the payment is $1,000 a month for a 30-year mortgage, the 25-year payment would be $1,100. And if the interest for the 30-year loan amounts to $100,000, you would pay only $80,000 just by decreasing the term by 5 years and making a little bit higher monthly payment. That's a savings of $20,000. And comparing a 20-year term, the payment is approximately 22% higher than a 30-year, but the interest savings is about 37%. So again, if the 30-year payment is $1,000 and the payment on a 20-year fixed rate would be $1,220, and the interest is $100,000 for 30 years, the interest on a 20-year term would be $73,000, or a savings of $37,000. You do have another option. You may want to take out a 30-year loan because it could afford you the lowest monthly payment. You can always add an extra dollar amount to your payment, and that amount you pay would be credited towards your principal balance. So let's say that you added an extra $50 to each payment. You would be credited an extra $600 towards paying off your mortgage during a 12-month time period. The difference with this option is flexibility. You can pay as much as you want, or if you're short on cash, just pay your regular monthly payment. And to get your pre-approval started today, turn on Turbo Mortgages by applying on our home page.
You're